Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Guy Johnson. With the cash trade just less than an hour away, here's what you need to know. Asian stocks follow Wall Street higher after a better than expected US jobs report. We'll look ahead to Wednesday's data on inflation. The oil rally takes a breather as Israel says it's pulling some troops from Gaza. Traders stand by for reports this week that will shed light on supply and demand in the market for crude. Plus, US Treasury Secretary Janet Yellen meets the PBOC governor on her final day in China as she aims to put relations with Beijing on a firmer footing.
Stocks fairly flat. We obviously had a lot of sound and fury at the back end of last week, but US equity markets and European futures really not giving us much sense of direction right now. I would look elsewhere for the action. I think the Brent crude story is fascinating. We'll talk about that in just a moment. And is this the week that euro-dollar finally cracks? We're going to find out much more about that story a little later on the programme. Markets Today starts right now. Monday the 8th, good morning. Lots to talk about. Let's start with oil and figure out exactly what's happening there. There's a big week coming up in terms of data. We start earnings season as well. We've got Janet Yellen in China wrapping up a trip there. But Anna, I think the oil story is really interesting. We didn't get an event over the weekend, and maybe that's why we're seeing the pullback this morning. I think you've also got these Netanyahu comments. Feels like Netanyahu's kind of just getting ready for something else, and the two stories are kind of related. Iran didn't do anything this weekend, but we're waiting. The Israelis are pulling troops out of Gaza. Are those troops going to be necessary for elsewhere?
Yes.
Maybe that's the story.
And just some troops out of Gaza. And you're right, I think, to focus on the Iranian story and the lack of very obvious response that we've seen to Israel over the weekend. And it makes you wonder how much you can read into the price action at the end of last week and this morning, because a lot of that did seem to be heightened tension going into the weekend, fearful that something might happen over the weekend. And that doesn't mean something doesn't happen in days into the future. But over the weekend, nothing happened, and therefore we see the oil market pulling back just a little bit.
You've also got the potential for a stronger dollar this week, which I think is interesting to throw into the mix as well. Euro-dollar has been very range-bound. We're going to talk to Juckes about this in a few minutes' time. But is this the week that finally cracks? You've got the ECB later on this week. You've got US CPI data as well, which we need to factor in as well. Feels like Europe and the United States may be diverging a little bit at the moment, and that may show up in euro-dollar finally. Yeah,
absolutely. There could be all kinds of FX interest, and it's a great day to have Juckes on the programme to talk about some of that as we look at that oil story, the dollar story, the strength of the dollar, what the euro is doing, and the yen. We'll come to that in a moment, perhaps. But back on the oil story, oil longs, their biggest since October. We're still seeing calls trading at a premium to put. So there is still that expectation in markets, even if we are seeing a bit of an unwind today. There is still the market, that sense that at least fast money in the markets is still betting on that oil price to go a bit higher. And supply concerns are part of that story.
And we're hearing $100 a barrel. People are talking about it. I think GS is one of the houses that is. We've already had JP Morgan coming out and talking about this, not core kind of scenarios, but increasingly it feels like 100 doesn't feel out of reach.
Yes.
And you do wonder what the implications of that are going to be, particularly as we go into the US driving season, particularly as we go in to a really critical period as we kind of try and gauge exactly how the Fed is going to respond to inflation. I think we get the inflation, I think it's the Fed's inflation 1 year forward expectation survey out today a little bit later on. And I wonder how oil is going to feature in that.
Yeah, oil very much a focus for us, because as well as focusing on the services side of inflation, we're still focused on goods as well, and the oil story is part of that. I think it is interesting whether we do get to $100, given we are seeing a lot of positioning, for a higher oil price. We talked about this at the end of last week, and our colleagues on the Markets Live blog saying, does it take even more geopolitical developments to push us there? Because even if things just carry on as they are, you don't necessarily get a sense that the market has further to run.
The market's very long.
Yeah.
That's the point that you made, and you can see that in CFTC data. You can see it everywhere. The market is very long. So as you say, in order to get it higher, requires something even more dramatic.
And on the supply side, there's plenty to watch as well. We get OPEC and the IEA delivering their reports this week, so she'll get some interesting lines coming out there. And it isn't just Iran escalation over the weekend that plays in here. We've seen developments out of Mexico and their exports. Obviously, we know Russian energy is sanctioned to a large degree. The Houthis, their attacks, not necessarily stopping, but delaying some of the movement of oil into global markets. And through all of that, OPEC Plus stick to its production cuts. And so there's there's increasing focus on that side of things as we get those reports from OPEC and the IEA.
Even iron ore was up this morning. So the commodities are all kind of getting into gear and taking us higher. Gold's a strange beast at the moment.
A hunt for answers was the title of one of our stories over the weekend.
I think nobody can quite figure out why we're seeing what we're seeing, given what's happening in the ETF story. And you look at some of the Chinese ETFs in gold, really fascinating stuff happening there. I thought the response to the US data Friday was in some ways quite strange, because what you've got here is the potential for yields to shoot quite a lot higher from here. People are talking about 5% on a US 10-year, but the equity market, which is always kind of glass half full, decided that actually a US economy that is strong, therefore should deliver higher equity prices. But that then puts more onus, doesn't it, on earnings?
Yes.
So we're getting into earnings season. You need, in theory, to have a great earnings season if the idea that the US economy is in good shape drives equity markets higher.
Yeah, these earnings seasons, I mean, is the gap between them getting
Seems
shorter?
to get closer.
Is it just something that happens with age? I'm not sure. But certainly it was fascinating, that price action. Yeah, stocks gaining, that no landing, price to perfection story still running over in the United States. And we are, as you say, going into earnings season. But it was interesting to see that, yes, yields went higher. Under different circumstances, that could have been something that spooked equity investors, spooked tech stocks, but that wasn't the dominant theme. The dominant theme was this is a US economy that's doing better than expected. Thank you very much. Equity investors will take that.
Yeah, but it now needs to be backed up with earnings.
Yeah.
So what do we start? We get the banks starting off on Friday. I think that's going to be quite a big moment. And again, they'll also give us a good gauge on what's really happening, maybe with the US economy. Yeah,
absolutely. So we'll look for that, look for earnings. We're also getting that, as you mentioned earlier, the CPI print out of the United States. That comes midweek. We're looking for 3.7% year-on-year and an increase of 0.3% on the core CPI, just the month-on-month figure. Glacial slowing is the description I saw attached to what we have going on with inflation at the moment in the United States.
The Fed, and we're going to get more today. I think Kashkari, there's a whole load of other speakers that are out today as well. The Fed is clearly finding this very difficult to deal with right now. They say they're data dependent. Powell's come out and said we're getting close to being able to cut, but then the data's taking us further away from that story. I think it's really difficult to judge. And we get through 4.5 on a 10-year. Do you get a 4.7? That seems to be the next story. And then 5%. And
you mentioned what we might see on euro-dollar this week. Well, could the CPI print be the thing that, gets us excited about FX? Because we could see some euro-dollar movement. We also could see some dollar-yen movement, of course. And we've heard from UADA at the back end of last week talking about, at least trying to perhaps keep in the market's eye the idea that it might not have been one and done from the BOJ and there might be more to come in terms of the rate story there. But there could be some movement in dollar-yen as a result of that CPI print, for sure.
The market is so short dollar-yen. It's amazing right now. I think it's a 17-year high in terms of the level of dollar shorts that we're seeing in dollar-yen. I think euro-dollar's fascinating. So you get a hot print on Wednesday. So it's 3.8. I don't know. Let's just kind of speculate here.
Yeah.
And then you get the ECB Thursday. Is it just June? Is it June to July? Is it June, July, September?
Yeah, is it June and July? Exactly. That seems to be the latest debate.
And kind of, do we get 4 this year? Maybe the Fed only goes 2 this year. Maybe the Fed only goes 1 this year.
Yeah.
Is that going to be enough to get us out of this kind of really tight range that we've been in?
Well, I am very glad we have Kit Juckes coming up to talk about that, because he can give us his thoughts on where that particular data print takes FX markets. Talking of FX, the yuan in focus, as we have Janet Yellen in China. There are other things in that conversation, of course, as well. But interesting that RBC saying that they're going to have to weaken the yuan more. The dollar is pressuring the top end of that 2% trading band that it's allowed to operate in, and suggesting this is a dollar spot thing, but it's also that the basket of currencies in focus as well, with regards to the yuan. So certainly a lot to focus on when it comes to the FX story. But Janet Yellen in China delivering some tough messages with a smile, it seems.
Don't try and export your way out of trouble.
Yes,
that's the
you're
message.
too big.
You're too big. You can't do it.
Yeah.
Like if with your industrial capacity, the scale that it's got, if you try and export, we are not going to tolerate that in the way that we once did. We've learnt our lesson. It ain't happening again, folks.
Yeah, China is too large to export its way to rapid growth, the line coming out of Janet Yellen. And some of that is what she said, similar to what she said on Friday. We've had these messages over the weekend, and we're likely to get more of this. In around half an hour, 20 minutes' time, I think we're due to hear, yes, from Janet Yellen a little bit later on in this hour. But one of the slightly newer lines, I thought, coming out over the weekend, a warning to Chinese companies if they support Russian business. And I thought that was a slightly different different angle on the conversation. Clearly, the geopolitics playing in there.
Yeah, I think she's got a multitude of things that she wants to talk about. That narrative, I think, is an interesting one in as much as clearly the Russian economy has been supported significantly by China. Just puts people on notice. Just be kind of ready for potential blowback on that. It takes us back to the yuan story as well, though. A weaker yuan would, in theory, also help that export push, which will be just another piece in the puzzle. So it's interesting that the fact that the Chinese are resisting that at the moment, I think maybe says that that is something they're very aware of, but they also want this to be perceived as being an alternative to the dollar. So if they let it go, if you get another big devaluation, you got the dollar on one hand, you got the yuan on the other, which is a more stable currency.
And always there's these times, we'll talk to Juckes about this no doubt as well, you know, there's the level that matters, but there's usually the pace is the question as well. And so whether they're just trying to slow the pace of something they see as coming will be interesting. But talking about the China story, we've also had that interview with the HSBC CEO, still putting the focus very much on the ability of that kind of business to do business over in China, and talking about India. And China versus India is another theme that we'll return to during this programme.
We'll come back to that. There's a great sort of piece out of Bloomberg on that story as well. So what have we got this week? There's some really key events. Today feels a little quiet, doesn't it?
Yes.
Lending survey Tuesday. Wednesday, you got the Reserve Bank in New Zealand. You got Bank of Canada as well. Fed minutes, which I think could actually be kind of a little bit of a quiet story, but could come a little louder later. And US CPI, 3.7 seems to be the survey.
Yeah, 3.7 core, 3.7 year-on-year. And as we said, we'll focus perhaps on what goes on the FX markets, but of course bond markets and how high those bond yields go. If we get something that looks quite toppy, as we saw on the jobs report. I mean, just to underscore the strength of that jobs report, we heard from Larry Summers as well earlier on talking about how strong it was. But hiring, total employment, participation, weekly earnings, all of those measures coming in above expectation. And Bloomberg Economics saying, yes, there is evidence of a two-track economy, but this is still a really strong report. We'll also hear from Ben Bernanke this week. The Bank of England is going to be receiving its report from Ben Bernanke. It's a report that digs into how they should forecast, essentially.
So I wonder... So I was reading a lot about this over the weekend. It almost feels like they're almost positioning this not as a review of forecasting, but a review of communication.
Yes.
And I wonder how much we're actually going to learn about the forecasting skills about the Bank of England, or how those forecasts are communicated to the markets. Some people are talking about dots, other people are talking about sort of more sort of ECB-like tools. Yeah. But is he going to be talking about communication, or is he actually going to be talking about the hard economics?
Right, exactly. And the way that the Bank of England uses market expectations of interest rates seems to be a critical element of this, because maybe that sets it apart and leads it into some communication challenges, as you rightly point out. So that could be something that's interesting. I mean, it is interesting. The story we've written over the weekend talks about scenarios, but we already get these fan charts from the Bank of England that would, in some people's eyes, suggest there are some scenarios behind that fan chart. But yeah, we'll get to the detail. And it adds some international sort of heavyweight status, doesn't it, to the conversation? Because a lot of voices in the UK have been critical of the Bank of England for missing that spike in inflation. Others saying, well, look, it was in good company. This was a global phenomenon.
And there's been a normalisation. So it's taken a while, but actually UK inflation has become more normal relative to others over time. So there's also a data lag story in all of this as well. The UK, I think, has a data problem as much as a forecasting problem. You get a model, you put rubbish in, you're going to get rubbish out. And that's been the problem. We've really struggled with the data that we're getting into the models. And I think that's something the bank maybe has to address as well.
That's something we'll pick up on later on this week. Coming up on the programme, HSBC is looking to bolster its wealth management business in China and in India. We'll bring you more from our exclusive interview with the CEO of HSBC, Noel Quinn, talking to colleagues over in Asia. We'll bring you that conversation. Plus, India prepares to take China's global growth crown as foreign investment floods into the nation. We'll dig deeper into today's big take story for you around the Indian growth story. If you have any questions, please do get in touch. It's Monday morning. IB plus TV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
This was a hot report that suggested that, if anything, the economy is re-accelerating.
It is a jobs report that confirms U.S. economic exceptionalism.
This was another incredible jobs report, right? 303,000 jobs created.
When you look at the 300,000 jobs that were created in the United States this month, it's on top of historic gains in the labor market.
I think we will end up with 2 cuts this year. It may not start as early as a lot of people thought initially.
I think the Fed would still like to get 2 to 3 cuts in this year. You need to see the data improve.
Both Mohammed and Rick Reeder there talking about potentially for 2 cuts this year, maybe, out of the Fed as a result of the payroll number we've seen Friday. Remember, we get CPI Wednesday as well out of the States. As Anna's been saying, 3.7 is kind of the headline number. It's not exactly a number that screams, let's cut rates right now. And then you've got the ECB out this week as well. Is it going to be talking about 4 cuts? Is that the messaging we're now beginning to get? Is it June and July? So this sets us up quite nicely for the question that Anna and I have been asking. Is this the week that euro-dollar finally cracks? We built him up. Now let's get the answer. Kit Juckes, strategist at Societe Generale, joins us now to answer that question. What do you think?
Actually, I doubt it. But
Come on, Kit. We're trying so hard this Monday morning.
I know. I'm sympathetic to the idea that I would love anything to move in this.
Be nice, wouldn't it?
Friday was a little bit telling in the sense that there really wasn't much to say in terms of the way euro-dollars moved in particular. We had a slightly stronger than expected U.S. manufacturing ISM. Down we went. We had a slightly softer services ISM. Up we went. Very, very, very sensitive to U.S. data and to the repricing of June, July rate moves. Friday was its big chance because
that was a good number.
It took about 3 seconds to do all the analysis you need on that. This is an economy that's growing at a slightly above trend rate. Not obvious why it needs a rate cut in June, particularly when you've got another meeting in July at the end of the month, which means you've got a whole load blast more. You'll get Q2 numbers coming out. Lots of information by then. It's a really easy decision if this week's numbers push them that way to delay. So with all that there, you sit there and think, well, OK, why would it not break higher this week? But because it didn't on Friday, I think is half the answer. If it can't react more than it did.
OK, so we've been talking about this as well. Isn't this the week, though, that starts to clarify the differences between the Fed and the ECB? Isn't this the week that the ECB is going to be kind of, we might go in June, we might go in July, kind of, Lagarde's got to be hinting at that kind of stuff if the committee's pressuring her to do that?
Yes, except that what we've had with the data in recent months has been so dismal in Europe that people hardly look at it. You can't have, I think I might have said before, but I hurt myself skiing, and as soon as the doctor identified what I do for a living, he just launched into what a mess the German economy is. I thought, if it's what we're going to discuss,
in Germany,
trying to anaesthetise you maybe with
exactly. but the result was, there is very little surprising about the softness in European data, and indeed, economic surprises in Europe are at the margin positive. In other words, they're not as bad as sentiment has become at the margin. That doesn't mean they're not bad.
OK.
And so I don't know that the European data... That's why we've been reacting so much more to the US than the European data. So, for example, this morning, it's a slight beat on German industrial production, which isn't to say, again, it's down less year over year than it was forecast to be. And that's where we are, I think, in all seriousness. So I think it's much easier... it would be much easier for euro-dollar to move... upwards for the euro on surprisingly weak US data than downwards for the euro on...
So it's the US data in the driving seat.
So I failed to crack Kit Juckes. Over to you.
OK, I'll go in with a different currency pair, shall I? So is it... do we get something interesting happening on the yen, then, as a result of this?
The dollar yen has got... we can see the positioning. I was in Switzerland just before Easter. The very clear presence of lots of funds who think the Bank of Japan's making a hash of this policy adjustment and are short yen, happy to be short yen, staying short yen, and very pleased to tell me all about it. So the CFTC data and the client base are as one. If they get a push through 152, I think they're going to push on. And given we're not very far away from it, they're not being pushed out of their positions because the carry's so attractive you can kind of trundle along for a bit. So it's almost easier that you certainly a big move in dollar yen is more conceivable to me at the moment than one in euro dollar, just because of that. I mean, that said, you kind of look at this and you say, hang on a second, I mean, the yen really is cheap up here in valuation terms. I think if it went up, it would eventually come back. But yeah, it's easier to see that one cracking in both directions because the positioning is there for a reason, but if it got broken, the other way it would go too.
So back to Guy's point about whether we get more clarity maybe on the ECB versus the Fed this week. I mean, you said it took 6 seconds to do the analysis on the jobs report on Friday. So did that lead you to conclude that the first rate cut will not be until September, or do you stick with the summer?
No, I think the real thing for me, the first piece is we'll see what the CPI data look like this week, but I wouldn't be surprised if you see a big shift in favour of July over June as the next move in the market, unless you get a different message. The Fed, I think it's clear, Jay Powell wants to use opportunities to get rates a little lower as long as the economy is not growing out of control. This is an economy that looks to me on the data as if it's growing a little above trend. You don't have to do anything, but rates are high and they don't want to. And there's still a lot of difference between suffering at the bottom end of the economy and joy for rich people that, it sat badly with Alan Greenspan, if you remember, in 2001, that. And I think there's a bit of Greenspan in Jay Powell.
I'm beginning to wonder how the market reacts, though, if we get that rate cut. Because in theory, everybody should be kind of jumping up and down and being very happy. But I'm also wondering whether or not the market will go, you're making a policy mistake. And as a result of which, we're going to take 10 years, not down, but up. And I just wonder whether we're kind of beginning to inch into that territory.
Yeah, I think we could get there. I don't know how. I think the market's quite split on, is inflation, it's just sticky, but it's sort of coming down that it's going to do it. For something that's as uncertain as the inflation outlook, this is playing out remarkably closely to the initial best guess of people who said, well, we'll get all the kind of easy bit done, then we'll have a sort of an uncomfortably high plateau, and then it'll take slower growth to get it down the last bit. That looks like spot on, which I thought at the time, that looks like the right best guess, but we haven't got a lot of inflation cycles to build our theories on. So playing out like that, you kind of look and say, well, the economy will slow down over time, but...
What if inflation stays around these levels, Kit? We don't get to rate cuts then, do we?
Again, they want to cut rates once or twice if inflation... It doesn't have to get to 2.5, if it just dribbles a little bit lower. So I think the odds are still in favour of that happening. I mean, I take Guy's point that, at some point... I mean, certainly some people will get nervous. Whether the majority will get sufficiently nervous for us not to react to a hope of a June rate hike with rising equity prices and general happiness, weaker dollar kind of theme. I think it's got to get. I think you might need a sort of some detail within the CPI number that makes you go, ooh, this has got some genuine long-term difficulty for me to see it, as opposed to what we've been having.
Is there any way that the Bernanke report could be pound positive? If the Bank of England... I'm stretching here, I appreciate it. But I'm trying to wonder how the market's going to react to this. If the Bank of England can figure out at some point how to communicate better, if there is a easier way to understand the reaction function, is that positive for sterling?
Potentially in the long run, although... I think, if it were the Kit report, saying, well, if we could get some labour market data that we can actually believe from anywhere, then the Bank of England could make some decisions about potential, all sorts of things. So what on earth are the Bank of England supposed to be doing, and what do we really think they're doing wrong? We have a problem that we've got stickier inflation than lots of other places for reasons we understand right now, and that we've got a worse inflation growth trade-off than pretty much anywhere else except for perhaps the Germans.
OK, Kit, thanks very much.
What do you do?
Kit Juckes, strategist at Societe Generale. I think someone should commission the Kit report. I think that would be well read. Yes, there we go. We've got the highlights. We've got the executive summary. Coming up on the programme, we'll get the executive summary from HSBC. The CEO telling us he's looking to bolster wealth management in China and India. This is Bloomberg.
Been
2023, the performance of our wealth and personal banking business here in Hong Kong, we saw significant customer acquisition growth.
Right.
We also saw around about a 50% growth in our insurance and wealth business in terms of the new business they were writing last year. So the facts are, wealth management is continuing to develop and grow here in Hong Kong. The liquidity base here in Hong Kong today is higher than pre-COVID levels. So I still see Hong Kong as a vibrant financial centre. Capital markets are subdued at the moment, but that's a function of still coming out of COVID, economies waiting to recover. What will inflation and interest rates do?
Right.
But we're seeing some early signs of the debt capital markets starting to pick up as well. So the facts, I think, support the fact that Hong Kong still is a vibrant financial market.
Right. Now, I know you're set to report your first quarter earnings in a couple of weeks, so you can't get into the details as well, but we just wrapped up, of course, the calendar quarter.
Yeah.
If you could also indulge us, how do you think the quarter went for you guys, generally speaking?
Well, 2023 went extremely well, over $30 billion of profit, a record profit. And that's a culmination of the hard work of our colleagues over the past 4.5 years, and also the loyalty of our customers. They've been very supportive of HSBC as we went through COVID and transition. Our returns were the best for over 10 years. And our dividend at 61 cents was the best dividend for 15 years. So I was really pleased with the performance. We're never complacent. We're making sure that we're well positioned for the future, and we're continuing to invest in the business. We're investing in wealth management here in Asia. We've done a number of acquisitions to do that.
Right.
The most recent one that we announced was the acquisition of the Citibank wealth management business in mainland China. We bought an insurance business off AXA in Singapore, and we bought an asset management business in India. And again, just to put it into context, every region performed well last year, and every business line. In India, we made over $1.5 billion profit. If you put BOCOM and our own shareholding of our own bank in China, we made over $3.5 billion profit.
Right.
So, well-distributed profit across the world, and all parts of the bank doing extremely well.
That was, of course, the HSBC CEO, Noel Quinn, speaking exclusively to us at the bank's Global Investment Summit, which is taking place in Hong Kong. It's still taking place in Hong Kong. In fact, we're going to take you there right now. Bloomberg's Haslinda Armin is at the summit with another fantastic guest. Has, over to you.
Well, that's right, Guy. Thank you so much for that. With me is Greg Guyett, HSBC CEO of Global Banking and Markets. Greg, good to have you with us. Your first interview with us, in fact.
Yes, indeed.
You know, when you take a look at this summit, 3,500 people, I mean, it got to be a reflection of that interest in China and how to go about investing in this market.
Well, of course. I mean, I would say that the number of people that have come to Hong Kong for this conference does reflect the fact that investors are looking for a good entry point into China, and they're starting to see some very constructive policies from the Chinese government and Chinese business to try to further stimulate the economy, and so I think it is a reflection of that.
So are we close to that entry point to China? I mean, some people say that we're possibly at the lows and it is time to perhaps dip your toes.
That's sort of my philosophy, because I think that now we're starting to see better comparisons quarter over quarter and year over year as the real estate and infrastructure slowdown has cycled through the economy. And if you look at the data, the investment that China's making in value-added manufacturing, a lot of it around these new economy sectors, EVs, hydrogen, solar and wind, you know, that's growing at 30% a year, and so it's starting to have an impact on the economy. And then finally, I do think that some of the policies the central government and some of the strong provincial governments are putting in place around the real estate and infrastructure sector. I heard recently that they've now removed restrictions on people buying second properties again. So I think these will help to control, you know, some of the remaining risks in the economy.
But the property sector remains an issue. Shimao today, for instance, is back in focus. To what extent has the problems in China impacted activity for your business in Hong Kong?
Well, there's no question that Hong Kong is very, very important as the financial center, the offshore financial center for China. And if you look at the primary markets, they've clearly been very, very quiet in Hong Kong. We've seen a lack of Chinese listings and a lack of, you know, investor interest in this part of the world because of the slowdown the lower growth that's happened in China. I do think that's starting to change, and I think the reflection of the number of people that are here is a function of that we're starting to see the Chinese economy growing faster, and we're seeing these sectors, and it's very bottoms up also. I mean, investors, what I hear here, are looking for these growth companies in China that they've been hearing about, that they've been seeing. That's starting to stimulate secondary market growth. I talked recently to Bloomberg, in fact, about the need for good secondary flows to then create an environment where the primary markets start to activate again, and I think we're starting to see that.
Speaking of secondary flows, in terms of client activity, what kind of activity are you seeing so far?
I think as a general sense, we've seen pretty good client activity and flows in the market in the U.S. Because the U.S. economy has been surprisingly strong, I think surprising to a number of people. We've actually seen some good primary market activity in the U.S. And of course, the other part of the world that's been continued to be very, very strong is the Middle East. You look at Riyadh, you look at Dubai, you look at Abu Dhabi. I would say that the pipeline of deals, the investor interest, continues to be very, very strong in that part of the world.
Before we get to the Middle East, Greg, I just want to know the outlook for the second half of the year, given that volatility is expected to increase with all the elections that are due, including the UK as well as the US.
Well, it's probably the elections that create volatility, but I think the volatility comes more from these changing expectations for interest rates and the changing expectations for growth in the economy. And there's no question that the fact that the U.S. economy continues to surprise on the upside has created a condition where we will likely see some more volatility, particularly if the Fed decides not to move in June, which is still currently the market expectation. And then the other side, as we were talking about a few minutes ago, the Chinese economy, I believe growth is starting to accelerate in China, and so this change in expectations will create a condition, I think, for more volatility in the second half.
But a Trump 2.0 may add to that volatility, don't you think?
Well, I think the volatility is likely in the run-up to the election because the outcome is going to be so uncertain. It's going to be such finely balanced outcome that the predictions are not going to be very clear one way or the other, and that does create conditions for volatility. If you remember last time that Trump was elected, we saw the markets drop quite substantially in the few days afterwards, and then recover and actually have a very strong performance during his tenure. So I think it's a little hard to predict what the market impact is going to be of a Trump re-election.
Greg, you've talked about how you're pretty optimistic for the rest of the year, and you've said before that you're looking to hire about 200. Give us a sense of where you're looking at, who you're looking at.
Well, first of all, we're looking at senior bankers that have good client relationships to try to deepen our strategic dialogue with clients. And then obviously the support around that is very important. I talked about the need to bring more younger people into the industry, develop them, apprenticeship. But if you look at the locations, I mean, it's basically the growth parts of the world where we have a strong footprint. So Singapore, Mumbai, Riyadh, Dubai, those are the big centers where we want to add people to our team.
Might you add more than 200 if the opportunities arise?
Well, it's very market dependent. And so I think for sure, and the other area that's really attractive to us, and it's just a huge opportunity for HSBC, is the transition economy, renewable infrastructure. And so I talked about in that interview the need to build out our infrastructure finance and our project advisory capability, focused on South Asia, focused on the Middle East. And so again, these will be big areas that I could see expanding even beyond that number.
Greg, thank you for your insights today. Greg Guyett, HSBC CEO of Global Banking and Markets. Heading back to you, Anna.
Haslinda, thank you very much. Bloomberg's Haslinda Amin at the HSBC Global Investment Summit taking place in Hong Kong. From Hong Kong, we go to Beijing, a similar topic of conversation in the sense that China and Chinese growth very much in focus. The US Treasury Secretary bringing her visit to a close, addressing the media. Let's listen in.
Risk to workers and businesses in the United States and the rest of the world. China has long had excess savings but investment in the real estate sector and government-funded infrastructure had absorbed much of it. Now, we're seeing an increase in business investment in a number of new industries targeted by the PRC's industrial policy, and that includes electric vehicles, lithium-ion batteries, and solar. China is now simply too large for the rest of the world to absorb this enormous capacity. Actions taken by the PRC today can shift world prices. And when the global market is flooded by artificially cheap Chinese products, the viability of American and other foreign firms is put into question. And we've seen this story before. Over a decade ago, massive PRC government support led to below-cost Chinese steel that flooded the global market and decimated industries across the world and in the United States. I've made clear that President Biden and I will not accept that reality again. I know that these serious concerns are shared by our allies and partners from advanced economies to emerging markets. China's excess capacity is built up over a significant amount of time, and our concerns will not be resolved in a week or a month. But the exchanges that we announced during this trip will provide a dedicated structure for us to raise our concerns about China's imbalances and overcapacity among a wide range of other topics in a detailed and targeted manner. We intend to underscore the need for a shift in policy by China during these talks, building on the over 2 hours I spent on this topic with the Vice Premier last week. This is part of our effort to advocate for American industries and prevent the significant economic disruptions we've seen in the past. It's important to note that I firmly believe that addressing these imbalances in an appropriate way will not only be good for the U.S. and the world, it will also be good for China's long-term productivity and growth. Importantly, we have and will continue to emphasize that our concern about overcapacity is not animated by anti-China sentiment or a desire to decouple. Rather, it's driven by a desire to prevent global economic dislocation and move toward a healthy economic relationship with China. Second, I was pleased to announce that we're expanding cooperation with China in our shared work against illicit finance. At home, President Biden and I have taken major steps to prevent illicit actors from exploiting the U.S. financial system and to hold them accountable when they do. But the United States cannot do it alone. Weaknesses in financial regulatory regimes abroad, in China and other countries around the world, also provide an avenue for financing for criminal organizations, human traffickers, drug traffickers, fraudsters, and other malicious actors that can harm Americans and our national security. From now on, a new joint Treasury PBOC cooperation and exchange on anti-money laundering, established during this trip, will enable our countries to share best practices and information to clamp down on loopholes in our respective financial systems. I've asked my team to begin these meetings very soon, and we look forward to reporting on our progress. I'm also pleased that illicit finance is a critical component of Treasury's work with the PBOC as part of the U.S. PRC Counter-Narcotics Working Group. Exchanging information on money laundering as it relates to trafficking of fentanyl and other illicit synthetic drugs can help us disrupt the flow of illicit narcotics, precursor chemicals, and equipment. The opioid epidemic is a crisis that affects every community in the United States, large or small, with more than 150 Americans dying each day. Treasury is committed to using all of our tools, including international cooperation, to counter this threat. Third, we're announcing that we will continue a series of financial technical exchanges between the United States and China. Just like military leaders need a hotline in a crisis, American and Chinese financial regulators must be able to communicate to prevent financial stresses from turning into crises with tremendous ramifications for our citizens in the international community. Over the past few
You've been
months,
listening to the Treasury Secretary, the US Treasury Secretary Janet Yellen speaking in Beijing, effectively wrapping up 4 days of talks with Chinese authorities. The line she's delivered, and she's delivered it on multiple occasions, is you guys have too much excess capacity. We are not going to tolerate, as we did before, you pushing that out onto the rest of the world. We will not see US industry hollowed out as a result of that. The language has been reasonably firm, I would say, stronger certainly than that delivered by Joe Biden a few days back. If you'd like to carry on listening to what is being said here, you can do it on your Bloomberg terminal. Live go.
Yeah, really interesting that she's going back 10 years, more than 10 years, thinking about the nature of this relationship, how much they've learned about the nature of this relationship, what impact it can have on the global stage, on US consumers, on US industry, and saying we won't go there again. And interesting, adding in those lines again about Russia, banks brokering military goods to Russia, risk sanctions. And this is another line in a tough line that she's taken, even with a smile, to Beijing.
She's certainly been delivering it with a smile, but the message has been a fairly tough one. And it'll be interesting to see exactly what kind of reaction we get. Keep an eye maybe on the Chinese currency for one barometer of what we are looking at there. What are we going to be talking about next? We're going to be discussing those red-hot US jobs numbers. We've seen the strong payroll data, certainly exceeding all expectations. We move on next to the CPI print, which is going to be out on Wednesday. We'll discuss that as we count you down to the market open here in Europe. This is Bloomberg.
Welcome back to Markets Today. We're 10 minutes away from the start of cash equities trading. The futures picture for Europe looks very flat, actually, flat to positive. The US futures story flat to negative this morning, but no great moves anticipated. Joining us now, Paul Dobson, our executive editor for Asia Markets, to talk about these markets in 2 minutes. Paul, thanks for joining us. Let's start with what we're seeing on commodity markets. My attention is drawn to oil because of the size of the moves and the impact that this can have on inflation expectations. We saw it ramp up into the weekend. Then we didn't get people's worst fears about what could happen over the weekend in the Middle East, and so oil drops this morning. What are we watching on the oil front?
Yeah, well, I think that's about right, Anna. In the background, there are lots of supply disruptions going on, particularly around exports and refined products and stuff like that. But front and center right now is the concern about tension in the Middle East. Last week, we had lots of verbal threats from Iran about the possibility of an escalation. Thus far on Monday morning, we have not seen that. There's been some speculation about the possibility that a truce might be getting nearer in Israel and Gaza. Not too sure about the veracity of those claims, but it seems at least to have taken a little bit of the heat out of the oil market so far today, which should be a relief for global markets more generally because the higher prices that we saw last week caused all of that turbulence right across markets.
And sticking with commodities, Paul, gold has really been in focus. New highs on the gold price, and a lot of people asking themselves how on earth this can make sense as we're dialing back rate cut expectations from the Fed.
Definitely. And we had a brilliant story of the weekend just asking that question. What exactly is going on with gold? I asked it in London a month ago when we were speaking with a bunch of hedge fund managers, and they were similarly curious about it and trying to make sense of it. I think that there's definitely some things going on beneath the surface. We know that central bank demand for gold has been strong, diversifying possibly out of US treasuries and out of the dollar. Some concerns about currency devaluation in some of the emerging markets may be popping up demand as well. But what we're seeing now is trend followers jumping on and bandwagon jumpers look at China as the perfect example of that, where ETFs have got misaligned with prices and the miners have been rallying like crazy.
Paul, thanks so much. Paul Dobson, our executive editor for Asia Markets, talking about all of the bandwagons people are jumping on, which is excellent. Thank you very much for that. Guy, just minutes to talk about some of the stocks in focus this morning. I'm drawn to Atos, Butler Industries, joining the top shareholder OnePoint in a potential rescue of this business. This is interesting, obviously, for the role it plays, but this is a business that's supposed to handle the cybersecurity for the Paris Olympics, which means, the clock's ticking for a number of reasons.
The French want this one sorted.
Yeah.
They were hoping that it would be an Airbus solution. It's not going to be an Airbus solution. We now need to find a rescue solution. As you say, it's not just the Paris Olympics. It's the US. It's the French military, which has huge connections into other militaries. This is a company. We've joked, I'm sure you and I have joked about this before. If Juckes is strategically important, Atos is definitely strategically important.
There's definitely an argument you can make there. What about upgrades, downgrades? We've got some.
There's a really interesting line. There's a really interesting note out of Citi this morning on chemicals. Pay attention to chemicals. They talk about it as being a once-in-a-cycle opportunity to pick up some of these unloved stocks. Once the chemicals start turning, and they're the base kind of building blocks for the economy. Pay attention to that. It's kind of useful cyclical kind of...
It is. And at the same time as we are hearing the likes of Goldman Sachs talking about, asking questions about whether we're going to see a global upswing in manufacturing. And that could be, that could be linked. Could that lift all boats, even the European one?
The other one I want to mention is Cakebox. Tiny stock, but apparently performance is above expectations. Apparently, here in the UK, we're maybe consuming a few too many cakes. Maybe just about the right amount.
Somebody is. Right, coming up on the programme, it is the Market Open. We'll bring that to you shortly. That's coming up. The futures picture has been pretty uninspiring. The week gets busier from here, though. This is Bloomberg.
Monday, the 8th of April. We're about to start a session which is going to start fairly quietly, but I think is going to have some potential to build as we work our way through the day. Keep an eye on what's happening with the bond market. You're already seeing yields ticking higher once again. That is something that the equity market may at some point actually have to pay attention to. And our oil stocks were up Friday as we went into the weekend. Do we see a little bit of an unwind of that maybe Monday?
Yeah, absolutely. It was interesting, wasn't it? On a day when we got some negative reporting around some of the individual oil names, it was the move higher in oil prices that lifted the stocks. So perhaps it will be the move lower in oil prices today as a result of our worst fears about the weekend not coming to pass that could be in the driving seat, certainly for London.
That's got to be a good thing. But some of the other commodities might be a little bit higher, which I think is interesting as well, as much as iron ore maybe starting to tick a little bit higher. I think the market's going to be feeling fairly quiet this morning. You're kind of unwinding a little bit out of Friday, but such anticipation for the CPI print, such anticipation for what is going to be coming out of Frankfurt with Christine Lagarde. But that story about kind of when do the Iranians respond, I think is going to hang over the market all week.
Yeah, absolutely. That'll be something we'll watch. And when we're talking about oil markets, we've got a couple of reports due out of the oil market. Later on this week, we'll hear from OPEC and the IEA, both of those out because there are the geopolitical stories that have been pushing oil higher, but also the other supply constraints, really, to do with Mexico, to do with Russia, the Houthis and their action in the Red Sea. So all of that in focus.
Looks like bonds are, though, ticking higher. It's going to be interesting. We've definitely seen an equity market that is firmly sort of fixated on the upside at the moment. But with that upside does come a cost of higher borrowing costs. But are we going to see also a differentiation between what happens in Europe with that borrowing cost story and what happens in the United States as well?
Yeah, the equity markets just don't seem too fast about higher yields right now. They're focused instead on the soft landing and what that can deliver for the US economy, and more broadly, we see how that plays out for Europe. So European stocks then just opening up, looking for, well, as Guy said, not a great deal of movement anticipated at the start of this trading day. We are expecting US futures are a little weaker, so that could add some downside a little later in the session. But perhaps we get a little upside in the meantime. No, not so, or just flat. The FTSE 100 opening entirely flat this morning. The market taking a little while to get its head in gear, perhaps, for this week. But it is going to be a big week. We're going to get CPI, we get the Fed minutes, as you said earlier on. There could be some interest there. Will we get a slightly more hawkish picture than the sort of benign Powell that we heard post that Fed meeting? So that's going to be something to watch for.
keeps setting us up, doesn't he? We're going to cut rates soon. We're going to cut rates soon. At some point, you're actually going to have to do it, maybe. Rio is up this morning. So Rio is popping by over 2% this morning on the upside. So maybe that metal story is going to give the FTSE 100 a little bit of traction this morning. The aviation sector is higher as well. Safran, Airbus, both gaining ground. BAE Systems tracking a little bit higher too. On the downside, some of the banks are a little softer, but actually some continuation, I would argue, from what we saw Friday. Novo's a little softer. ASML looks like it's a little bit softer as well. LVMH as well on the downside. SAP giving back a little bit of ground, actually, despite the fact that it's maybe going to be laying off some staff, which usually delivers a positive response on the cost front. But some of those big heavyweight luxury names and chip names are soft.
I think it's interesting, given what we were saying about oil and the way it responded to negative geopolitics on Friday, how it could have responded to positive geopolitics today. This is oil stocks. They haven't. So, you know, just like we were talking about, a lot of the fast money is positioned long oil. You wonder whether, you know, there's a similar sort of thought process going on here with investors who own energy stocks. They're not necessarily selling them at the first sight of 1.7% weaker on Brent.
No, but that comes back to the expectation that at some point Iran is going to respond.
Yes.
That potential doesn't disappear just because we went into the weekend long. We've taken some of that back a little bit. Maybe you do see that coming through, and maybe that we still don't know, so the risk, therefore, still exists. So maybe you hang on to those stocks. I do wonder as well, there's a lovely Javier Blas piece this morning talking about the fact that maybe BP and Shell could relocate to the States, which would give you a significant multiple.
Little provocative talking point at 5 a.m. this morning in London.
If people are talking about the fact, I was talking to a fund manager about this the other day, people are talking about the fact that the British government wouldn't allow BP to be taken over, because in some ways BP is a perfect takeover target, trades on a low multiple. You could easily, it's big enough for some of the US guys to consume, but it hasn't happened, which tells you the British government would be happy. How would the British government react if Shell and BP both said, see ya? Right,
yeah, absolutely. And Javier Blas quotes Shell management in that story, saying, you know, there's some frustration that the London market puts this very different valuation on their businesses, not necessarily to do with anything that they do.
Yes, some of it I think is self-inflicted, in as much as they went down the renewables route.
Different choices were made, different regulatory backdrop as well.
It's not just the market on which they're listed. There were some choices that were made as well.
Let's have a look at what we've got on tyre makers as well. Continental was one stock that was gaining this morning. Pirelli is the top European pick for Jefferies. They don't like Michelin much, but it's one of those days, isn't it, where you're seeing some of these reports, reports from brokers having an impact on share prices.
So ironic, because in some ways this is a macro week. But actually on a Monday, with little actually of that macro news to talk about, it's the single stocks that maybe have the bottom-up story that has the biggest impact.
OK, so that's what we're seeing. Zalando, also a decent gainer, getting an upgrade to buy at Citi. So just underscoring that point that we've got those upgrades and downgrades having an impact today. Let's talk about the bigger macro picture, though. And let's start with reflecting on where we've been on the Fed conversation post the payrolls number as we run up towards the CPI print, the middle of this week. After the payrolls report, we heard from the Fed's Michelle Bowman. We know that it's too soon for the Fed to cut rates. We've heard that a lot, and given that we've seen such strong data on inflation and jobs, that's a pretty easy argument to make. But what is the Fed watching for when it comes to that comfort level they want to start cutting rates? Let's listen in to what Michelle Bowman had to say.
Should the incoming data continue to indicate that inflation is moving substantially toward our 2% goal, it will eventually become appropriate to gradually lower the federal funds rate to prevent monetary policy from becoming overly restrictive. However, in my view, we are still not yet at the point where it's appropriate to lower the policy rate, and I continue to see a number of upside risks to inflation.
Joining us now is Wei Li, Global Chief Investment Strategist at BlackRock. Wei Li, very nice to speak to you once again. Let's start with the overall Fed expectations. Have they shifted since Friday, since we got that strong on many measures payrolls report as we run up towards the CPI print midweek? What is your current expectation around when the Fed starts to get to rate cuts?
Hey there, good morning, Anna. Well, we still think that June rate cut is likely, although the very strong payroll report last Friday certainly kind of make it more debatable now. We're talking about a labor market that is not only tight, but actually also quite strong, thanks to the 3 million immigration over the last 2 years. And that means the economy could support a higher level of payroll growth, maybe 200K a month, which is double of what we saw previously without stoking inflationary pressure. So we're talking about a reasonably strong labor market against the backdrop of a reasonably resilient economy. And that means, yes, we're still expecting June rate cut starting and 3 cuts for this year. But actually, probabilities of that decreasing and being pushed out a little bit more after last Friday's payroll has increased. And this is also on top of the hotter than expected inflationary print in February, both for CPI and PCE.
Wei Li, talking about equity markets and their response to the strength of that data, do equities continue to take the strength of this data in their stride? Do equities continue to say, we like the soft landing story, we're buying that, we're not going to be concerned about any delays to Fed cuts?
Well, right now, equity markets are very much responding to strength of the economy as well as strength of earnings, notwithstanding the fact that we have had meaningful hawkish repricing on the rate front so far year to date, going from 7 cuts at the beginning of the year to 3 cuts, give or take, right now. So I think as long as earnings continue to hold up, the growth story and the narrative of immaculate disinflation will continue to support market sentiment, which is why we remain risk-on in U.S. equity markets, leaning into where we have seen earnings growth, such as AI and tech.
Wei, good morning, it's Guy. Do you think, though, the momentum is going to start to slow? I guess, presumably it gets harder and harder to generate upside for these equity markets. What do you think the rate of change is going to look like? We've had a very strong start to the year. Does that continue, or do we start to maybe plateau a little bit here?
Well, we're certainly looking at a rising bar from here, given how well equities have done, not just in the U.S., but globally as well. So we have talked about the fact that so far it's been the earnings driving equity upside, but earnings have been actually revised higher in terms of expectation as well. So we're talking about, for the broader U.S. equity market, 11% earnings growth for this year expected, and the tech sector, 18%. Earnings expected. And even for the broader market, ex the Magnificent Seven, we're talking about 8% earnings growth expected for this year, which is higher than the levels that we saw in terms of consensus at the beginning of the year. So the bar is rising, which makes it harder to beat as we start earnings season. So I think you're right, Guy, that it's going to be harder to continue the momentum that we have seen so far. But we do see this year, which is also why we do see this year as a year of 2 parts. Beginning of the year, first half of the year, first part of the year, supported by immaculate disinflation, earnings strong, growth strong. But at some point, markets would wake up to the fact that we are in a world of higher for longer, inflation settling at higher level, and rates settling at a higher level than what we got used to.
Goldman Sachs is out with a note this morning. Their strategists talking about the idea that this year we are going to see, certainly for the rest of the year, Europe outperforming the United States as the catch-up trade kicks in. Do you agree with that?
Well, Europe, in terms of the absolute return we have seen so far in local currency, has already outperformed the US, and that has been supported a little bit by kind of the restart in China, data stabilizing, but also the fact that generally kind of coming from a low multiple levels, there is a bit more room for European equities to kind of deliver performance against a broadly risk-on backdrop. Now, having said that, we are still talking about an environment where in Europe, growth is worse than the US. Yes, it's benefiting from a bit of a global cyclical manufacturing upturn, but in terms of the growth dynamics, is worse than the US, and European central banks. ECB is very much facing the trade-off between kind of inflation. Yes, it's coming down faster and surprising on the downside. But inflation versus growth, that trade-off still very much faces the ECB as well. And it's debatable, even though maybe they should cut sooner, if they will cut sooner, right? Because ECB tends to kind of take the lead from the Fed. So because of all of that, we actually still prefer the US equity market over Europe, while recognizing valuation is more attractive for European equities. And certainly there are very attractive selective opportunities within the European equity market universe, such as European banks, for example, which we have liked.
Okay, so the European bank story stands out to you. Can I ask you about, another crucial factor in the European growth story has been China for a long time. We're watching Janet Yellen, Treasury Secretary in the US, still delivering her remarks and taking questions from the world's media as she makes her visit to China. She's been talking about not wanting to see China try to export its way out of trouble and actually to try and stimulate domestic demand. Does this have investment implications for you, Wei Li? What are you expecting to see in terms of the balance of demand drivers in China as we go through this year?
Well, for China, one risk, especially in the context of this year, is the big T word, tariffs. We need to kind of think about what the implications could be, as both sides seems to dial up their engagement, which is always good. Talking is better than not talking. Now, the broader context for China is that, again, we're talking about a very low starting point, both in terms of equity valuation as well as in terms of kind of data coming from the very depressed levels that we saw last year. So certainly there is room for kind of a bit of a rebound, bounce higher from these very depressed levels, especially given what we have seen in terms of easing, not the bazooka that would kind of engineer a meaningful turnaround, but certainly a concerted effort to want to stimulate the economy and support the market. So that being the case, given a very low starting point, we could see a bit of a bounce back for the sentiment towards China. But over the longer term, we are expecting Chinese economy starting with a 3 handle by the end of this decade. So structural kind of growth headwinds very much impacting China, aging population, the need for reform. When you bring all of this together, we actually think that we are neutral on Chinese market equities and bonds. There are better kind of opportunities outside of China beyond the near-term rebound from the very low levels that we're seeing.
Yeah. Let's talk about Japan. We're all watching what's happening with the currency, but we're also paying attention to what's happening with the equity market. How much do I want to put in Japan right now? How big a upside do you think that could be? We've already seen a decent run. Kind of give us your sense of the potential there and how big a part of the portfolio it should be.
Well, so far, what has driven Japanese equities has been very much the macro story. The country finally exiting decades-long deflationary mindset. And because of that, we actually upgraded Japanese equities 3 times the last 12 months or so. And we're very much encouraged by the fact that, yes, BOJ is exiting NIRP, negative interest rate policy environment. They're still very much kind of watching where yields are for JGB, Japanese government bonds. Nominally, they dropped the yield curve control, but they actually also then said that they would immediately kind of respond and be very responsive if there is unexpected rise in long-term yields, right? So we still very much think that YCC is implicitly in place. The macro environment is broadly supportive. Earnings are strong, and there are some micro developments from the corporate side, actually, that should drive the next leg up for Japanese equities, which is why we keep our overweight at this juncture, even after the very, very good run that we have seen.
Wei, great to see you. Thank you very much indeed. Wei Li, Global Chief Investment Strategist at BlackRock, joining us. trying to monitor exactly what's happening with these markets and figure out where we go from here. Do we actually see volatility picking up? But other markets outside the US certainly becoming more on the radar. Let's talk, Anna, about some of the stocks that we are watching. Here are the kind of the core ones that we watch around Europe. Fairly mixed bag, I would say, this morning. It's interesting to see LVMH and ASML both soft. But Novo's turned around a little bit. That's now positive. Schneider's a little positive as well. Nestle, I can't form a clear theme that runs through this.
You're seeing bigger movement in those than you're seeing in the overall indexes this morning. That's for sure, because the overall index moves are pretty slow.
Pretty minimal.
The stock 600 at least is only up 0.1%. The CAC and the DAX do move more, though.
Yeah, I wonder whether there's some of the luxury names maybe kind of turning around a little bit, but we'll keep an eye on what's happening with LVMH. I think that's going to be an interesting tell there. But Nova, yeah, some of the drug stocks are having a better day as well. Some of the other moves that we're watching, keep an eye on the miners this morning. They're up on the back of the fact we are seeing iron ore having a more positive day. To Anna's point earlier, some of the notes actually are causing some movement this morning. So you've got some of the chemicals makers that are moving too. There's a note out from Citi. So you've got, I think, Clariant is up. Wacker's also trading higher on the back of an upgrade coming through there. In terms of other stocks that we're watching, Entain is the biggest gainer on the stock 600. Barry Gibson is going to be stepping down. Stella David is going to become the new who became the interim CEO, will become the chair after Gibson retires. That seems to be having a positive effect on that stock. Zalando as well on the move too. That's another upgrade-downgrade story, isn't it?
Absolutely, yeah. Zalando getting an upgrade to buy at Citi on an inflection in growth is the reasoning there. They're saying that the German online retailer should see a return to gross merchandise value growth in 2024. So we'll certainly keep an eye on the clothing retailer out of Germany there. Also focused in on, again, another upgrade story. This is around the tyre makers. So Pirelli named as the top European tyre sector pick over at Jefferies. They're less keen on Michelin, but the whole sector, they're saying, is going to benefit from some structural tailwinds as a result of a shift to larger rim sizes and technology-enabled tyres, which is...
Technology-enabled tyres.
Something we all know we need, apparently.
AI tyres. Now, it feels like people have been looking for where the AI story goes next.
Where do the chips move next?
Yes, round.
That's part of the answer. Coming up on the programme, we have mentioned the basic resources story. Energy also in focus this morning. The oil rally taking a breather despite geopolitical tensions in the Middle East continuing to escalate. We'll get more on that next. This is Bloomberg.
Monday the 8th, 20 past the hour, 20 minutes into the trading session, and drum roll, nothing happening, at least at an index level. Below the surface, there are plenty of nice little single stock stories that we're watching out for, but it's interesting to see London, maybe a little bit of underperformance coming through today. Elsewhere, we're up by around 0.4%, a little bit of a carryover maybe from what we saw on Friday. I would argue maybe the action continues to be in the bond market. Yields continue to tick higher. US 10-year up again this morning. 4.432 is where we're trading. European yields continuing to track higher as well. Pay attention to that. That could be the theme that maybe unites this week. The other theme that could unite this week is what is happening with the crude price. And we're a little lower this morning, but we were quite a lot higher Friday. So I think you need to bear that in mind. And maybe we got a little bit over our skis on that one. Traders are now waiting for a series of events that are going to maybe inform us as to where we go next. You've got the kind of supply side story from OPEC and the IEA. They'll talk about demand as well. Plus, we're all waiting to see exactly how the Iranians are going to be reacting. A more strong language coming out of Tehran over the weekend. Stephen Stepchinsky, did I get that right?
Yes.
Nearly.
Let's check with him.
Anna's been tutoring me. Is here to talk to us a little bit about how the markets is going to be set up going into this week. Let's talk about the geopolitical story, Stephen, first of all, and figure out exactly kind of what traders are waiting for. So we got a little bit over our skis Friday. We were waiting for some sort of Iranian response. We didn't get that, but we're still anticipating. So this move lower this morning doesn't feel like a trend shift.
No, I don't think so. I mean, first off, you pronounced my name perfectly, so don't worry about that. Second off, yeah, we're not in a trend shift situation. I think we are seeing prices trend lower, likely because, one, we were in a overbought situation. The Brent 14-day RSI rose above 70, signaling overbought conditions. Second, you also have the comments over the weekend from Israel. They said on Sunday that the country is pulling some troops from southern Gaza, with the forces recuperating, preparing for future operations, including an offensive. So yes, they are pulling back, but at the same time, like you said, the world is waiting for what Iran will do in response to Israeli attacks on their consulate in Syria. So you're kind of in this wait and see situation. Oil really sort of tumbled because of that as well. There are a number of reports to wait for from the EIA in the United States to OPEC as well. So that's going to kind of color the week as to how the market is currently shaped.
Okay, and you mentioned some of the geopolitical themes that we're watching, and of course, yes, over the weekend, things that could have happened didn't, and so as a result, the oil price perhaps retreats a little. But there's also some more supply-side driven themes away from the geopolitics, Stephen, that I know are keeping the market focused. Talk us through some of those.
Yeah, I mean, I think it's a wide range of things that have surprised the market, and this is a supply-driven market. Don't get me wrong, right? There is a geopolitical element to this. There is a risk, a war premium because of what's happening in the Middle East, but we are in a situation where fundamentals are driving the prices. So you have OPEC Plus has continued their cuts of about 2 million barrels a day through the end of June. What are they going to do after that? It's not clear, but they're much happier with oil prices around $90 than they were before when it was below $80 Brent. At the same time, you also have Mexico. Mexico is reducing their heavier crude exports to fill their domestic needs. That's going to cut back supply from U.S. refineries. They're going to have to use their own supply. And also, there was this cold, it's kind of interesting how this is all happening together, but there was a cold chill, a freeze in the United States in January, but that cut a bunch of barrels out of the market from the U.S., and they're just catching up. So because of that, U.S. inventories are also a bit lower. As well, we also have, going forward, Iraq is saying that they're going to try better to cut their exports. They haven't been hitting their OPEC Plus targets. So we're probably going to see less supply out of Iraq and Russia as well.
Stephen, product markets have been stronger than the barrel market recently. And I'm wondering whether or not, as the barrels come up, do we see product accelerating further forward, or does that spread start to close? Because none of us buy barrels of oil, we buy product. So what's happening with product prices?
Yeah, so there is a bit more of a crunch on product markets. Most recently and famously, Russian refineries have been hit because of a number of attacks. We also went through a period of refinery maintenance that usually happens in the United States and other places. But yeah, I mean, that is the question, right? If crude prices rise, will that lead to a similar increase in gasoline prices, or will that spread shrink? And that's going to be something that, if I'm Joe Biden, I'm going to be watching very, very closely, because that is the big question. If crude starts to head towards $100 and you're seeing a similar gain in gasoline prices, suddenly the U.S. is calling up OPEC Plus, they're calling up Saudi Arabia saying, hey, can you unwind some of these production cuts? So it's not immediately clear what will happen. There is a crunch with refining capacity, so you could see things rise further, but who knows? The Chinese might be able to come out and really boost their capacity. There are a number of different things that could happen in the market that could solve this, but at the moment, it does seem that there's more pressure, not just on the heavier products, Brent, but also potentially the products like gasoline.
Stephen, thanks so much. Thanks for bringing us an update. Stephen Stapczynski there with oil markets and beyond. Coming up on the programme, India is vying to take China's global growth engine crown as foreign investment floods into the country. We'll get more on our big take story next. This is Bloomberg.
Monday, the 8th of April, half an hour into the equity session. Nothing to see here thus far. Single stock stories, there's a few of them floating around. Bond yields are a little bit higher once again. It's a continuation, really, of the theme that we saw Friday. I think we're waiting for the next catalyst, clear catalyst, for these markets to move. One of the stories that we watched back end of last week into this week as well has been Janet Yellen's trip over to China. That's now wrapping up, Anna, but the message has been pretty unequivocal.
Yeah, absolutely. To a number of constituencies she's speaking here, isn't she?
Yeah.
She is trying to give a fairly positive take on things, saying that relations are on a stronger footing than they were just a year ago. And we've seen she and Biden meeting, of course, within that time period. She said there are difficult talks on national security, but the ones from an economic perspective that really stand out are the message to exporters, China is too large to export its way to rapid growth, and the message around those banks that might be helping the Russians at this point.
Yeah, that's maybe the new bit that you've been flagging as well. Let's get a take on what exactly is happening here and maybe bring it all together. Bill Farris, Bloomberg's Bill Farris, joins us now. Bill, has the language, has the tone been stronger than we were anticipating? We had the Biden-Xi meeting at the beginning of last week, the phone call. That really didn't deliver anything, and we were wondering whether or not Yellen's trip would be more of the same. It certainly hasn't been.
No, you're right, and I think you hit the nail on the head at the top there. I mean, she did cover a wide range of issues in these discussions. She said in her press conference just now, said she discussed everything from Russia and national security to TikTok, but really the main message, the theme we've hit on almost every day that she's been there has been this idea that China's overcapacity and how that is a priority not just for the United States, but according to Janet Yellen, for a large number of developed and emerging market economies. There's a lot of concern about how China is trying to bolster its economy amid slowing domestic growth. And Yellen in the U.S. made clear that they think the current approach has to be rethought. She actually used those kind of words. It's not clear that China is really going to shift strategy, but they did signal some openness to talks. There's going to be continued economic talks about what Janet Yellen said would be how to rebalance growth in the global economy.
Yes, it is interesting that she put this in a historical context, didn't she, Bill? She talked about how we've learned a lot over the last 10, 15 years about the relationship between China and the United States, about what China can, how much Chinese export the world economy can tolerate, what damage, if you like, or change or challenge Western economies are prepared to tolerate in the face of those Chinese exports. So there's a lot of history here. What has China's response to all of that been?
Well, there's been disagreement about whether there really is an overcapacity issue. You heard Chinese Commerce Minister push back on that idea. But yet again, I think the fact that there are some kind of talks set to take place shows that Beijing is at least interested in continuing to have these discussions with the U.S. I think Janet Yellen is right in saying that the relationship is on a much stronger footing than it was, say, a year ago when we went almost an entire year without senior level meetings at any level. So there's much to be said for just continuing those talks. Janet Yellen said she is not interested, the U.S. and the Biden administration are not interested in seeing a deterioration in U.S.-China ties. Coming in as a message coming during an election year in the United States, that's saying quite a bit.
OK, picking up on that, Bill. So the message has been delivered. When are we going to know if the Chinese have been listening?
Well, I think we want to see when these talks actually take place. We expect Secretary of State Antony Blinken to be in Beijing in the coming weeks and months. Are we going to see a big shift in Chinese industrial policy? No, I don't think so. I think it's going to be more about when talks happen, what kind of interim issues can they make some progress on. And we're also going to have to see what the Chinese reaction. I think this will be key to what could be incoming tariffs from the U.S. administration on Chinese goods and restrictions on more high access to high technology. Those are things that we've been reporting for weeks, are under consideration, potentially in the works at the White House. And the Chinese reaction to that will be key to see where this relationship is headed.
Bill, thanks very much. Bloomberg's Bill Farris with the latest on China-US relations. The China growth story clearly looms large over those conversations that Janet Yellen, the US Treasury Secretary, has been having in China. Another growth story, though, very much in focus globally for global investors. India is the subject of today's Bloomberg Big Take story. The nation is vying to take China's crown as the engine of global growth. This as foreign investment comes into the nation and its government lines up a number of new trade deals. Let's talk more about this. Today's Big Take then, we will bring in economy and government reporter Anna Roy, who is across this story for us. Anna, very good morning to you. And so in what way is India then looking to take China's crown as this engine of global growth? Because we see varying estimates as to what it can achieve over what time horizon.
Good morning, Anna. We are talking about how India and China are contributing to the global growth. They are the two main engines of global growth right now. So China and India jointly contribute about half of global growth. India's share is just about 16% and China's share is 34% of this total world GDP growth. So if India can manage to grow at 2 percentage points more, from just about 7 to 8% now to maybe 9%, then what we are saying is that India will be as important as China as the global growth driver. Maybe in 2028, going by the best case scenario that we have. Otherwise, we are estimating that by 2037, India and China will be the two equal partners in global growth.
Let's just talk about how India achieves this and what are the impediments to achieving this. What does India need to do to make that happen? One of the key areas I keep reading about is infrastructure, but is it just infrastructure? Are there other areas that India needs to focus on?
Yes, so India, first of all, to sustain a kind of growth like 8%, 9%, India needs to work on many things. One is that it has a demographic dividend, but that is good only when they are skilled enough to participate in global manufacturing. So India needs to rapidly scale up its its workforce, its labor force to global standard. So skill development is important. Increasing the participation of female labor force in the total workforce is very important for India. India needs to house this kind of workforce in urban areas. So urbanization is required. 65% of India's population is still dependent on agriculture or living in rural areas. You need to shift them to urban areas. So urbanization is important. For urbanization, you need proper infrastructure. India's infrastructure is improving. It has increased its infrastructure budget maybe by 3 times in the last 5 years to 11 trillion rupees. But it needs to do more. So infrastructure needs to improve. And finally, India needs to bring a lot of manufacturing companies onshore to generate jobs for this population.
Yes. I was going to ask you about that because I'm wondering what this means then for India and for the world if India does share space with China as the main global growth driver. I guess that means optionality for big global manufacturers. They can choose China, they can choose India. Take us through your thinking.
That's right. So one is manufacturing, and second is that India can offer a huge market for these manufacturing companies. But more than the manufacturers, it's the producers of commodities who benefit the most, because in early 2000s, China really drove the agenda for the commodity cycle, commodity prices. If they have an option in India as well, India can be one of the important agenda setters for the commodity prices. So it makes you from a price taker to price setter. That is important for India. That is totally dependent on energy, energy import to meet its need. And for producers, that means better price discovery as well. And for manufacturers, you have a ready market where you can set up shop and then you can sell it in the domestic market if exports don't work out.
One of the things we've been watching is the Modi government being quite difficult in terms of the negotiations that it's conducting with other nations when it comes to trade deals. It's playing its cards very close to its chest. Modi has been very cautious, and getting these deals done has, as a result, been very hard. Do you think there is... Does that start to change as India gains more importance in the global economy. How does the Modi government perceive its relations with other big trading blocs changing as it goes through this transition?
Well, any economy will want to see its interest first. So the trade deals that India negotiates with the world, India's interest should come first. And because of India's democracy, and there is a lot of opposition to government policies, etc., so it has to be very cautious about it. However, if you want to be a real global growth driver and want to be a really important player in the world, then you will have to link up more with the world. You will have to agree to the trade negotiations and the terms. And India is actually doing quite well with these kind of trade negotiations. And slowly it will expand more.
Anna, thanks very much indeed. Anna Broy joining us on this story, this huge competition that will shape the global economy in decades ahead. What are we going to do next? We're going to look ahead to Thursday's ECB rate decision. Christine Lagarde, maybe she starts to push the button finally on rate cuts. But is it just June? Is it June and July? How many rate cuts are we going to see this year? We'll discuss that next. This is Bloomberg.
This is Markets Today, 44 minutes into a European session that has a little bit of upside, certainly coming through from the French market and the German market. The FTSE 100, though, much more range-bound, so that's flat. But elsewhere, we are seeing a little bit of upside. So the stock 600 up by around 0.2%. US futures have actually, in the last half hour or so, turned themselves to flat to positive rather than the flat to negative that we had previously seen. But we won't make too much of that. It is a busy week ahead. Some of the highlights, then, Guy, that we have, of course, coming up this week. Of course, the ECB will be in focus on Thursday. But before that, their lending survey comes out tomorrow. We get central bank decisions from the ECB, but also the RBNZ, the Bank of Canada, the US CPI print will be in focus. And then later in the week, we get that report from Ben Bernanke around, forecasting in the UK.
Yeah, and it'll be interesting to see whether that's about communication or about actual forecasting. We were talking to Kit a little bit earlier on, making the point that data in, poor, data out, poor. That seems to be the story. I think the timing is interesting, though, with the US CPI data Wednesday. If that turns out to be strong, you downgrade expectations of the Fed, and then you get to the ECB on Thursday, where potentially we're upgrading expectations for the number of cuts we could potentially be seeing.
And we don't know how long this persists for, but certainly you're into a period where you've got expectations that the ECB is going to cut, and it's very live, and they're very quite, they're imminent in the sense it's coming in a few months' time. And increasingly, you're asking questions about when on earth is the Fed going to cut, and that we could be in that period for a while.
And how many cuts do we get, and how quickly will those cuts from the ECB become? There's a great story this morning talking about kind of July now being the battleground. It's not we're done with June. June feels like it's a done deal. July is now where the action ultimately could end up being.
Yeah, absolutely, and that seems to be where the market's thinking has gone of late. Joining us now for more on this, Bloomberg's Jana Randau joins us from Frankfurt with a preview of the ECB. That decision then, Jana, coming, as you well know, on Thursday. What can we expect then to hear from Christine Lagarde, from the ECB president, come Thursday?
I think what we will get is some sort of a signal on what will happen in June, a confirmation in a way of what has been the expectation in markets among economists for a very long time, that the ECB will first lower interest rates at its June meeting. And that the president has laid out that path at a conference in March. And pretty much everybody has signed on to that timeline. A few policymakers still haven't excluded April, but we think that's more a negotiation position than anything else, and kind of a strict adherence to the data-dependent principle that the ECB adheres to. So a signal for June we expect. Based on the fact that inflation is slowing, it's slowing faster than expected, actually. That the economy is showing green shoots and is coming out of its weak phase, its winter lull, if you want. how far we will be able to look beyond June, that is less clear, simply because the ECB likes to look at data, and a lot of it will come by the June meeting. So I don't think we'll learn a lot more about where the path of travel will take us for the ECB in terms of interest rates this year.
Okay, but you're talking to a lot of people, and economists are trying to figure this one out. The battleground seems to have gone from June, which feels like a done deal, to July. Where do you think the centre of expectation is right now? Is it 3 cuts this year? Is it 4 cuts this year? Is it cuts in quick succession? Is there a desire at the ECB to get on with it and get it done and deliver kind of a big impact? Or is it, let's see what an impact of 25 bips has and then we'll move on from there? I'm just kind of wondering what you think the thinking looks like in terms of the sequencing.
My feeling is that they are pretty relaxed about it. So when we look to economists, they expect a move once a quarter. The market is pricing between 3 and 4 cuts this year. And in terms of policymakers, there is really only Greece's Yannis Stonaras, who said he wants to see 2 cuts before the summer break, which is traditionally in August, so a June and July move. Everybody else has been fairly quiet on details, saying yes, we need to ease. There's room to ease, but really saying we need to look at the data. And of course, especially the hawks have been saying, you know, just because there's a June cut, don't expect that there will be one in July, and we need to really look at the forecast. We need to look at wage deals. So my hunch is they will take it as it comes, if you want, looking at the information as it becomes available, and then taking their decision, ultimately saying, well, you know, 4 months or 4 weeks in an easing cycle is not going to change the economy much, of course, because of policy lags. So I don't get the sense that there is a particular urgency at the ECB to now move at every single meeting.
Jana, thank you so much. Thanks for the preview. Jana Randau there with the latest from Germany on what we're expecting to get from the ECB. Well, in focus, the ECB rate decision, of course, this week. Also in focus this week, a report from the former Fed chair, Ben Bernanke. That's expected to be delivered to the Bank of England, and we'll get to see the contents of it. It's going to be suggesting that the Bank of England adopt a new innovation, a flexible set of scenarios in a bid to update its forecasting process and repair its battered reputation. For more, let's talk to Sophia Horta-Acosta from our Markets Today blog, who's gearing up for covering all things UK this week, of course, on that blog. Sophia, good morning to you. Let's start with this Bernanke report then. Much anticipated, nice global heavyweight opinion to add to the conversations in the UK about where policy goes and how decisions should be made. What stood out to me from this was the way that they're asking questions, or Ben Bernanke is going to be asking questions about the way the Bank of England takes market rates and puts them into its forecasts. And that results in some explanations required that maybe are a bit sophisticated for every consumer.
Yeah, and exactly. And the problem is when the market is really kind of expecting something that the BOE doesn't necessarily think will happen. And how do you communicate that to the public versus to the market? And there's been a disconnect between that. And it's not just the BOE. I mean, the Fed, the ECB, they've all had that problem. But the BOE is really the only major central bank that uses market forecasts in its communication. So how do you solve that problem? There were expectations that when Ben Bernanke was asked to review this back in July, that maybe he would go towards kind of the Fed dot plot model, and that's you know, a lot more specific, kind of maps out what MPC members, where MPC members expect interest rates to be. It doesn't seem like he's going to go down that path, and really kind of presenting a range of scenarios does give the BOE perhaps more flexibility as it had during the pandemic, where, you know, it could reflect where various MPC members expect things to go depending on where the economy is going as well.
Is he going to recognise that not only does the BOE have a forecasting problem, it also has a data problem? The problem with these big models is that you put poor data in, you get poor data out. It's very hard to forecast. The market rate story is just one element of that, but the labour market data has been really difficult as well.
Yeah, exactly. And obviously, that's not the BOE's fault. It's the kind of when we were looking actually on the blog at last week's jobs report in the US, the level of detail there, you can see how many women have joined the labor force in really kind of niche jobs, and you just don't have that level of detail in the ONS data. You also just, I mean, it's very late. It's about 2 months after the actual month, and this, you know how useful it is. That there have been criticisms from the BOE itself that it's not really kind of useful data.
So there's differences then across the Atlantic, but they both share this challenge, which is, you know, in an age where perhaps trust as a notion has been eroded, trust in all kinds of institutions, people don't necessarily want to answer surveys, and that seems to be one of the issues that the ONS was running into with its surveys. But that's one that will run and run, no doubt. Really interesting on the London market to pick up on this piece by Javier Blas, our colleague at Bloomberg Opinion, talking about the very real threat for the LSE if it loses some of its energy giants. And this taps into a theme, you know, the London stock market might go out of its way to try and attract new tech listings, but there are many voices who'll say, don't do that, just concentrate on keeping the big names that you've got. And that's what Javier is getting at here.
Yeah, exactly. Concentrate on kind of really kind of elevating the valuations. Are so low in the UK. And this Javier's piece is great. He speaks to big CEOs all the time. He spoke to Shell's CEO. Shell is actually a company that's been doing quite well. The shares rose to a record last week. But still, when you compare the valuations of a company like Shell listed here in London versus Chevron versus ExxonMobil, the valuation gap is just so wide. And Javier is saying, the point that he's making is that people just don't value carbon fossil fuels here in Europe, not just in the UK. There's almost a hostile environment for these companies when it comes to investors, and ESG investing is perhaps more of a trend here than it is over in the US. We also got data this morning from the team at Goldman Sachs that showed more than £5 billion has now left UK dedicated stock funds this year, and that's only this year. And when you consider where that money is headed, a lot of it is in the US, and that's still where the high valuations are. So there's a risk there that, you know, companies see this and they think, why are we even here? Why are we listed in this kind of market?
We either relist or we get taken over by private equity.
Exactly.
In terms of the smaller companies, maybe the US private equity industry is better at valuing some of these companies. Sophia, thank you very much indeed. Much more on this on the blog. You can get it on your Bloomberg terminal on the front page of the UK website as well. TLIV Go on the Bloomberg. We've been debating this morning how you say this name.
Yes.
So
I'm going to leave it to you, Guy.
Pooch, apparently, is how you say it. So Pooch is planning to raise $1.25 billion in an IPO in Spain. So this is Paco Rabanne, this is Charlotte Tilbury. So there are listings taking place here in Europe, which there have been very few recently.
Yeah, absolutely. And this is the second time we're talking about perfumes listing, isn't it? We had a conversation with the CEO recently. I don't know if there's a trend there. That's a bit niche,
I'm pretty sure I mispronounced that company's name as well.
Well, we're all good at that. But this is interesting because it takes us into bank earnings season, doesn't it? Because we're going to be focused on banks at the end of this week.
I'm trying to work out how you go from perfume to bank earnings.
Oh, you watch.
I'm sure there's a capital markets kind of...
Yeah, exactly. Investment banking and IPOs. That is going to be something of a theme, isn't it, as we get towards the US bank earnings season. But also commercial real estate, of course, we'll watch that as well.
Absolutely. I just want to hear what JP Morgan has to say about the US economy, because all the data at the moment speaks to this idea that the US economy is very strong, that US consumers are very strong. They have got higher FICO scores. JP Morgan's got much higher FICO scores, so you're kind of getting a top-end slice of the US economy. But nevertheless, it should be a really useful indicator.
Well, here's something that might apparently boost the US economy. Don't ask me how. Travel is involved, apparently. You've talked about Taylor Swift many times, but there is a solar eclipse coming, and North America gets a great view of this. And I've seen, in a note from Ben Emons, actually, to give him credit, there's a range of estimates that this could add $1.5 to $6 billion to the US economy.
So I'm going to be very British about this. Apparently the weather's not going to be good enough to see it.
You need to be high
most
up,
of America.
and you need a clear sky. Yeah,
exactly.
Apparently, if you're in Wales or some parts of the west of this country, you might get a glimpse.
Again, back to the weather. Always fantastic.
Always back to the weather.
Yeah, but America is going to be in the dark throughout most of this week, potentially.
That's where the focus will be stateside. That is it for markets today. European equity markets modestly higher today. US futures flat to positive. That's Monday. This is Bloomberg.